In Silicon Valley and beyond, a fascinating paradox is unfolding, one that's reshaping the financial landscape of the world's most influential companies. Tech giants, long celebrated for their enormous cash reserves, are now borrowing money at unprecedented levels. Despite sitting on mountains of cash, these companies are issuing billions in new debt, a move that's raising eyebrows across Wall Street and Main Street alike. The driving force behind this shift? The relentless race to dominate artificial intelligence. As AI becomes the new battleground for innovation and market leadership, financial strategies are being rewritten in real time. Once, these companies were lauded for their prudence, hoarding cash as a buffer against uncertainty. Now, they're tapping bond markets to fund the staggering costs of building AI infrastructure. From massive data centers to cutting-edge research labs, the strategy has shifted dramatically, from cautious capital preservation to bold, debt-fueled expansion. It's a high-stakes gamble, signaling a willingness to take on risk in pursuit of technological supremacy. The fear of missing out on the next wave of AI breakthroughs now outweighs the traditional aversion to leverage. For many executives, the risk of falling behind is greater than the risk of taking on more debt. Companies are betting big, believing that leading the AI revolution will ultimately justify billions in new borrowing. They're investing in infrastructure, talent, and research at a scale never seen before. This is more than just a financial footnote. It's a defining story of our era, filled with both extraordinary promise and significant peril. The stakes are enormous, and the outcomes will shape the future of technology and the global economy. In this chapter, we'll break down the numbers, explore the motivations behind these bold moves, examine the risks, and consider what this new era of debt means for the future of tech. The story is just beginning. The numbers are staggering. In 2025, global tech companies issued $428.3 billion in bonds, a historic high. U.S. firms led with $341.8 billion, reflecting Silicon Valley's central role in the AI race. European and Asian companies followed, raising $49.1 billion and $33 billion respectively. This isn't a minor uptick, it's a tidal wave of capital reshaping the sector. The era of hoarding cash is over. Debt-driven expansion is the new norm. Across continents, tech leaders agree, dominating AI requires massive, front-loaded investment. The global rush to bond markets shows a universal belief that today's AI investments will decide tomorrow's winners. The stakes are high, and companies are leveraging like never before. The AI arms race is driving this debt spree. Building state-of-the-art AI means constructing vast, specialized data centers packed with advanced chips, costing billions. The pace of innovation is relentless. Today's tech is obsolete in months, not years. Companies must constantly upgrade hardware and invest in proprietary AI models and top talent. Microsoft, for example, is pouring billions into OpenAI and Azure, while Oracle is expanding its cloud infrastructure. These aren't optional projects, they're existential for staying relevant. The choice is stark: borrow heavily for AI or risk falling behind. Debt has become the essential fuel for this high-stakes marathon. This borrowing boom is fueled by low interest rates and eager investors. Tech giants can lock in cheap, long-term financing, preserving their cash for flexibility. Investor demand is sky-high. Bonds from these firms are seen as safe bets. Offerings are often oversubscribed, letting companies secure even better terms. Why spend your own cash when you can borrow cheaply and keep a safety net? This dynamic lets companies amplify growth while minimizing immediate impact on reserves. The AI boom is powered by both internal ambition and external market appetite. The door to cheap money is wide open, and tech is charging through. Today's tech investment cycle is relentless and unforgiving. AI hardware becomes obsolete in just a few years, forcing companies into constant reinvestment. Billions spent now are only the first installment. Staying competitive means perpetual upgrades. Executives face pressure to announce ever larger spending plans, fueling more borrowing. This go big or go home mentality boosts short-term sentiment but isn't sustainable long-term. Tech is shifting from asset-light to capital-intensive, more like manufacturing than software. The difference? The cycle is much faster. AI data centers age in years, not decades. Companies must budget for recurring massive capital outlays. Debt is now a necessity, not just a growth tool, in the age of AI. The AI boom is exposing new financial risks for tech. Median debt to EBITDA ratios have nearly doubled since 2020, signaling rising leverage. Cash flow coverage is thinning. The median operating cash flow to debt ratio hit a 5-year low in 2025. Massive AI investments are immediate costs, but returns are still on the horizon. This mismatch strains financial ratios and leaves companies vulnerable to downturns. If AI bets don't pay off quickly, debt burdens could become a major liability. An economic slowdown could squeeze cash flows, making debt harder to service. The strategy designed for future dominance could backfire if the AI payoff is delayed. The risks are real and growing. The bond market is starting to show caution. Investors are demanding higher premiums for risk, as seen in rising credit default swap (CDS) spreads. Oracle's CDS spreads nearly doubled in late 2025, reflecting concern over its heavy borrowing for AI. Even Microsoft, with its stellar credit, has seen its risk premium rise. The trend: even the strongest players face increased scrutiny as debt piles up. These market jitters are a reality check amid AI optimism. The CDS market signals that the probability of negative outcomes is rising. As tech debt grows, investors will demand more compensation for risk. The era of easy money is getting more complicated. Despite rising debt and growing market caution, big tech companies continue to demonstrate remarkable financial resilience. Even as economic headwinds gather and interest rates rise, these industry giants remain pillars of stability in the global economy. Their ability to weather storms is rooted in a combination of strong fundamentals, strategic foresight, and a relentless drive for innovation. These companies still generate massive profits from their core businesses, easily covering new debt obligations. Their revenue streams, from cloud computing to digital advertising and subscription services, continue to grow, providing a steady flow of cash that few other sectors can match. Their vast cash reserves act as a crucial safety net, allowing them to invest aggressively in research and development, or to weather periods when returns from AI and other emerging technologies may take longer to materialize. If the economy stumbles, these reserves provide a buffer that most companies can only dream of. Their scale and dominance give them a captive audience for new AI products and services. With billions of users worldwide, they can rapidly deploy innovations, gather feedback, and refine their offerings in real time. Brand power, global reach, and deep customer relationships further de-risk their investments. These companies are trusted by consumers and businesses alike, making it easier to launch new products and enter new markets with confidence. The risk profile is shifting, moving from an era of extremely low risk to one that is now low to moderate. This change reflects both the increased leverage and the evolving landscape of technology investment. Increased leverage is a calculated risk, not reckless gambling. These companies are making strategic decisions, weighing the potential rewards of innovation against the manageable risks of taking on more debt. In reality, they're using only a fraction of their immense financial power to secure the next big opportunity. Their investments are targeted, measured, and backed by deep analysis and experience. Concerns about rising debt are valid, especially in a changing economic environment. But these worries must be weighed against the extraordinary strength, adaptability, and resources that big tech brings to the table. For now, big tech's fortress walls are not just standing, they're fortified, signaling enduring strength in an uncertain world. As 2025 draws to a close, the world of technology finds itself at a pivotal crossroads. The industry is making its boldest bet yet, pouring unprecedented resources into artificial intelligence, even as it racks up record levels of debt. The stakes are enormous, and the outcome is anything but certain. This year alone, companies have borrowed a staggering $428.3 billion, a figure that dwarfs previous years and signals a collective belief that AI is not just the next big thing, but the very foundation of the future economy. The sheer scale of this investment reflects a near-universal conviction that those who hesitate risk being left behind. Boardrooms across the globe are abuzz with urgency. Executives are leveraging their companies' balance sheets to the limit, convinced that the cost of inaction far outweighs the dangers of mounting debt. For many, the fear of missing out on the AI revolution is driving decisions that would have seemed reckless just a few years ago. The challenge ahead is immense. Companies must find a way to balance relentless innovation with prudent financial management. Every dollar spent on AI must be justified, every risk carefully weighed. The future will demand not just vision, but discipline and adaptability. Investors, too, are watching closely. They will scrutinize every move, demanding transparency and clear strategies for turning AI investments into real, sustainable profits. The pressure on leadership teams has never been greater, as shareholders seek reassurance that these massive bets will pay off. If these gambles succeed, the rewards could be transformative. Tech giants will not only cement their dominance for another generation, but also reshape industries, redefine work, and set the pace for global innovation. But if the AI thesis falters, the consequences could be severe. Companies may face painful deleveraging, layoffs, and a fundamental reassessment of their strategies. The dream of AI-driven prosperity could quickly turn into a cautionary tale of overreach and hubris. This debt-fueled boom is the price of admission to the AI age, a bold, calculated risk that will define the winners and losers of tomorrow's economy. The willingness to take such risks is itself a testament to the transformative promise of AI. In the coming years, the world will watch as this high-stakes gamble plays out. Will it be remembered as a stroke of genius that propelled humanity forward, or as a costly miscalculation that set the industry back? One thing is certain, the stakes have never been higher, and the outcome will shape the future for decades to come.